This is the future of finance.
This episode is brought to you by Metis Global Partners and by the Intentional Endowment Network's 2025 Annual Forum, taking place October 27th and 28th at Goucher College in Baltimore, Maryland. Hey everyone, thanks for tuning in to the Future of Finance podcast. I'm Georges Dyer, and I am super excited about our guest today, Hallie Label from Expect Equity. Expect Equity is a really innovative model that provides public equity asset managers from backgrounds that are underrepresented in the investment industry with a platform to build a track record and those long-term relationships with capital allocators that are really necessary so they can go on their own and be set up for long-term success. In doing so, the model addresses some of the key persistent barriers that have held some people back in the financial industry and really helps allocators take what Hallie calls an expansive approach to talent. As we discuss, Expect Equity is essentially an incubator, and Hallie has an amazing background working with some of the best investment firms out there. So she really knows what she's talking about and has a ton of experience and networks to make this model work. We also talk quite a bit about the role of trustees and investment committee members in setting the right policies and incentives for their investment teams, and some of the cultural dynamics around that. So if you're a trustee, I'd love to hear your thoughts. And for others, please share this with any trustees at your organization or in your networks. As always, please like and follow the show. And I really hope you enjoy this one. So here is Hallie. Hey, Hallie, how you doing? Good to see you.
Good, thank you. How are you today, George?
I'm doing well. Thanks so much for joining the podcast here. I'm really excited to get the word out about your work at Expect Equity. Yeah, just to get us started, I mean, you've had an amazing career in institutional investment before starting Expect Equity. You're with Hall Capital Partners, McKenna, Rock Springs Capital. So yeah, tell us how those experiences shaped your views and what kind of prompted you to go out and start Expect Equity.
Yeah. So I think for any entrepreneur, having a large intractable problem that the market isn't solving is really exciting. And I think all of those experiences that you mentioned were important because over the course of my career, I've sat on kind of every side of the table. So I've been a direct equity investor. I've been an allocator. I've been an operator. I was a COO at Rock Springs. So having this kind of very broad understanding of different people's goals and incentives is really helpful in designing solutions to an intractable problem. So I think the other thing that was particularly interesting to me about the issue of the great underrepresentation of certain groups as GPs and owners of investment firms is that solving it both creates kind of financial upside and it creates values alignment. So it's a big problem. I think there hasn't been a ton of innovation in trying to solve it. I think there are systemic reasons why it's intractable. And I think for anybody who can make decent progress on it, there are just huge opportunities to unlock value and to make the world a better place. Yeah.
Well, it seems like you've come up with a really innovative, exciting way to sort of change some of that, try something new here. Let's talk about just the problem first. Your tagline is excellence is broadly distributed, but capital is not. So tell us a little bit about what this state of play looks like in the field and why you think that is.
So the Knight Foundation is the most authoritative source, and their most recent data, as far as I'm aware, is from December of 2021, and most of your listeners are going to be very familiar with this. 1.4% of capital in this country is run by firms owned by women and people of color. I will start by saying at Expect Equity, so that's our definition. That's how we think about underrepresentation, is people who are underrepresented relative to their percentage in the population as leaders, owners, and general partners in the asset management industry. But there are lots of other people who are also underrepresented. So we do not limit our universe to the demographic groups I mentioned. We take a very expansive and inclusive approach to who is underrepresented, but all of those individuals with those demographic characteristics are underrepresented. And to my knowledge, if you look at the data that Knight has published going back 10 years before 2021, that needle wasn't moving. It's not like that was on a trajectory. It was on a flat trajectory. We don't have good data since then, but anecdotally, I can tell you, I don't think it's changed much since then either. We'll get into in this discussion a lot of the reasons why I think that's the case and why I think it continues to be intractable. But that's kind of the starting point. is that the problem has been known and identified for a long time, but there is no natural mechanism for self-correction.
Right. Yeah. So tell us what your sort of idea was with Expect Equity and just kind of a quick overview of what it does.
So we have one goal at Expect Equity, and that is to launch firms owned and run by underrepresented managers at scale. I'm a huge believer that to actually succeed in this business, it's really, really hard to start very small and build. You have to start at scale to really have a chance. So we designed everything from the beginning to have sort of access and to be prepared to accept capital from large institutional investors. And when I say large institutional investors, I mean endowments, foundations, OCIO firms, potentially family offices, large and sophisticated institutions. They have certain expectations about a lot of things. Track record, quality of the back office, and duration of the relationships with the people they back. Because ultimately, investment decisions hinge on trust. It's not about returns first, in my opinion. It's about trust first. And so to design something, we had to create mechanisms for trust to be established, and that can only happen over time. So at Expect Equity, managers join us. They get 3 years to invest and build a track record. During that 3 years, we're also helping them develop and cultivate relationships with institutional LPs. And we're doing all of that while providing them with very high quality back office infrastructure that's commensurate with what these institutional investors expect to see. In my opinion, at managers many times our size.
Yeah, that's fascinating. I mean, I think that's such a salient point about trust. And I think one that doesn't really get articulated explicitly enough in these conversations. I think people do default to like the track record of the financial performance. But yeah, it's so true. I mean, did you see that like as you were looking at this intractable problem over your career at these other, kind of marquee firms that was the dynamic?
Well, having sat in an allocator seat for many years and having presented many managers to leadership or partnership of the firms where I worked, every time I did that, every time anybody who sat in a seat like mine and who presents a manager to whoever the leadership or governing body is putting their personal, political, and professional capital on the line for that manager. So the decision to do that is an intricate kind of combination of what a portfolio needs or what a client needs or what their incentives are. And because you're putting yourself on the line, most people in that role can withstand some investment risk. And we'll talk about this more later also, but investment risk can be mitigated if you're doing something new and innovative through position size. But operational risk is exceedingly hard to mitigate from the outside. It has to be done right from the inside. And so having had the experience of presenting managers for approval many, many times over the course of my career, it was very salient to me, the risks that we were asking our advocates to take. And that led to, things that we considered in terms of design that were meant to mitigate those risks as best we could. And not every risk can be eliminated. And the investment business is a business where you are taking calculated risks.
Sure.
We're very specific about what those risks are. And we tried to mitigate all the business risks and find ways to mitigate the investment risks also, again, predominantly by position size.
And when you say the operational risks or business risks, is that like the back office infrastructure kind of component?
I mean, there's two reasons that matters a lot. The first is that anybody who sits in my seat as a general partner or owner of an investment firm is a fiduciary. We owe a duty ethically and legally to our clients. And without proper back office infrastructure and internal controls, how can you represent that you're fulfilling that duty, right? So that's the first reason it's important. The second reason it's important is that LPs expect it. And so if you want to have a chance, if you want to be able to present to and compete for an allocation from institutional LPs, you need to have an infrastructure, a group of service providers that look like what they're used to seeing. And part of that, I mean, that's just kind of a cost of doing business. That's a baseline expectation. Those service providers have to agree to work with you. And different ones of those do different amounts of diligence based on the type of service they're offering. But because there is again, this is a multi-layered web of trust, right? And because those service providers have essentially agreed to work with you, it's another way, it's another tool, it's another sort of piece in a communication toolbox to tell somebody like, this is a person that's building it the way it's supposed to be built.
Yeah, that can instill that confidence.
That's right.
Yeah. So for people who aren't immersed in this every day, to explain a little bit about what that infrastructure looks like what is back office? What are some of the components of it?
So we're a private fund. We're a Cayman master feeder fund. So we have an onshore fund and an offshore fund, and this is an exceedingly common structure for hedge funds. It happens all of our managers are long only public equity. I know there's a kind of broad audience here. That just means people who buy stocks and don't short stocks. So in a private fund structure, you need an external administrator. You need a well-regarded tax and audit firm. You need fund formation counsel who puts together all of your fund documents, a private placement memorandum, a limited partnership agreement, your subscription documents. And there are groups that are well known in the industry to be very high caliber, ones that do lots of this work. And so those are, those are three examples. We have an outsourced CFO firm. But, all of a typical pitch deck for, somebody in our shoes has a list of all of those service providers. And that list is a signaling mechanism about what type of back office infrastructure we've built.
Right. So if someone's going out on their own, trying to start their own fund, and they're sort of trying to be scrappy and doing some of that themselves or using firms no one's ever heard of, that's not going to instill the same kind of confidence of what you provide in terms of the infrastructure.
And I through mutual friends or whatever, people send aspiring managers or newly launched managers to me, and we have this discussion. And my opinion is if you cannot raise the capital to build it right the first time, you should wait until you can and not get started with infrastructure that you would consider kind of not quite institutional ready. And what some people say to me is, well, when I get that institutional client, I'll build out the infrastructure that I need. In my experience, 25 years, like again, one person's opinion, you're going to get different answers from different people. It's going to make it a lot harder for you to get that institutional client. Again, because you're asking somebody who sits in the seat that I used to sit in to either help you build it, which they really don't know how to do, or to take on this huge extra
risk,
political, again, when I say political, I mean like political capital at an organization, but risk on your behalf.
Their own sort of like career risk almost. Yeah.
Right. Exactly. And I just think almost nobody will do that, and almost nobody should do that.
Yeah. Yeah. That's fascinating. What are some of the other, aside from this like infrastructure and the back office stuff, what are some of the other common barriers that you have seen preventing underrepresented people from getting into asset management?
I mean, it's really about access to capital, right? It's about, having been in the industry as long as I have, there were people I met when I started at Hall in 2006, right? And even if I haven't kept up with them extensively over time, we crossed paths and we remember each other. And it's very hard to replace like that duration of relationships. And so I think for a lot of people who are, whether senior analysts or portfolio managers at long-only firms or even at some hedge funds, if they're not client-facing, if they're not seeing those allocators come through, getting to know them, getting business cards, remembering them, and developing a rapport with them, to start if I were to start a software company, go raise venture cap, like I don't have a network,
Right.
to figure it out sort of, but I'm an unknown quantity, right? And so that's part of why we've created this 3-year time period, which some people argue isn't even enough. But at least, we are having our managers engage with institutional allocators well before they are ready to launch independently to start developing those relationships. So I think that lack of relationships, the lack of back office know-how can be overcome. You can sort of figure that out. But relationships,
you can't really
built overnight.
Right. Yeah. There's only one way to do that. And that's really interesting too, because we hear a lot of, new managers saying, we're not really new. We've been doing this for 20 years, as you say, but if it's in a portfolio management role, they might be great investors or whatever. But yeah, if they're not client facing, they don't have those relationships. And that's a big difference when you're going out.
The other thing we see too is, if somebody's a portfolio manager, a boutique asset manager, a big long only, they're running a fund because somebody handed them a prospectus or a set of strategy guidelines and said, you are being promoted to run this, right? Not what do you think is the best expression of your investment style and process? How would you construct a portfolio, right? It's, we have, this amount of capital. If you're a co-PM, the senior PM retires, you step up and become that senior PM. You're running this thing that maybe you've been helping to run. Maybe you've been in the passenger seat. Now you're in the driver's seat, but you didn't set up the parameters.
Yeah.
Right. And if there's so much capital that they need to own 150 stocks because of, liquidity or ownership limits or whatever it may be, like you might think 40 or 50 or even 25 is better, but it's not a choice because that's not what your job is. And so the other thing that we do is we ask our managers, like, regardless of whether you have been a PM in the past or not, what product would you design that you think is has the best chance of generating material long-term capital appreciation and outperformance? And there has to be alignment with that, with what I have a history of diligencing and what our investors want, which is relatively concentrated fundamental equity. But as long as that alignment exists, we give our managers flexibility in that design.
Yeah, fascinating. Speaking of the financial performance piece there, the outperformance, share some of the data that you've seen around, how underrepresented managers can perform financially? Because I know that's also a big question in all this.
Yeah. So, there have been several studies over time. I'll tell you candidly, I don't spend a lot of time reading them, but I think if you were to summarize the core findings, broadly, there is not a difference in performance based on demographic background. And that's logical. Why would there be, right? I think some have said if you have teams of people with different backgrounds, which doesn't just mean demographics, it might be career history, it might be educational history or background. But if you have people who have the psychological safety to challenge each other and bring different ideas to the table, just like in any organization, right? Any form that tends to lead to better decision making broadly. I think the studies have shown, again, logically, it tends to lead to better decision making and investment management. But I think these studies, while they can be helpful, I'm not saying more should not be conducted, but I don't think they're that salient to allocators, because for an allocator, again, it's each individual decision, and each individual decision has to stand on its own. They can't take home, and their organization can't take home, prior performance based on, large scale academic studies.
Right. They're just looking at that one manager and making that assessment, basically. Yeah. And do you think it's more, because we hear all sorts of reasons and people have different opinions as to why the numbers are the way they are in terms of representation, that 1.4% kind of figure. Is it your sense then that it's just really predominantly these like kind of structural things around back office and the relationships, or do you feel like there is implicit bias in there that, if people don't look like me, or, that there's less of a sense or comfortableness with making those allocations?
I think there probably is implicit bias, but I think the most important driver of the intransigence of this problem is incentives. CIO incentives are set by the trustees, and the investment team that's out doing the manager research and selection and surfacing the ideas and doing the research to ascertain like who's going to be presented are incented by the CIO. So, but it all flows down from the incentive set by the trustees. If there is only career advancement potential for bringing forth managers who look like templates of prior success, and importantly, if there is no cost from a career perspective, if those managers perform poorly, then that's what everybody's going to do, right? So if you set up an incentive structure that says go out and find IBMs, you're going to be brought IBMs. So if somebody said, how would we change this, right? If I'm a trustee and I feel like I have a portfolio of IBMs of large incumbents, that is a signal that is what the people on the team feel incented to present and ultimately to invest in. And so if I believe that we are constraining the universe of talent or the types of firms that we will consider, and as a result missing out on additional return opportunities, portfolio diversification opportunities, whatever it may be, then I know that I need to change the incentives, because if I change people's incentives, I'll change their behavior.
Yeah, it's like there's only downside basically of kind of going off the normal path right now. What does that what does that actually look like in terms of changing it, or potentially, what could that look like in terms of changing those incentives for the team?
And again, I can throw out things that'll never happen. It's not that I believe that this is, that this is a real, but if somebody really wanted to be creative, you could say, okay, you bring me a manager that's going to have a multi-billion-dollar launch at premium terms, long-term lockup, high fees, and lots of our peers are invested with this manager. You can bring those managers all day long. In my experience, some of them do well and some of them don't. I'm in no way am I saying that everybody who looks like that does poorly. That's definitely not true. Some of them are exceptional investors, remain motivated, and raise an amount of capital that they can put to work for excellent returns, however they define that, right? But it is, in my view, and based on data I've seen, not at all the case that everybody who is a popular launch, oversubscribed with premium terms, generates these returns that you would expect from somebody of that kind of elite or, prestige or caliber or whatever you want to call it.
Right.
So if I were a trustee who wanted to set creative incentives, I would say, your bonus is going to be docked if you choose those managers and it doesn't work out. Because now I'm forcing somebody to really make an investment decision rather than an access decision. And again, I'm not making universal comments about allocators, but diligence processes and protocols and the way things are often done and have been done for a long time, again, under this kind of framework of trust, there is more trust when others like you, other large foundations, other large endowments are investing with the same manager. Well, they must have seen something promising in that manager. Right. This manager must have, a great long-term track record at a prior firm, whatever it may be.
And that just builds on itself. Everybody sort of gets on the train. Yeah.
Right. But it may be the case, and I know some allocators who think more through the lens of what I'm about to say, which is at the point where somebody can raise that much money at those types of terms, they are far less incented to work hard to generate those exceptional returns going forward. They weren't gotten the reward, which is that long-term management fee stream from raising that much capital, right?
Yeah.
And so if you care more about motivation and grit and resilience, you're going to be a little bit less interested in those access-constrained managers. Some people care about, some people love the access-constrained managers. They feel safe. Those are, some people care more about the grit, the hardworking, the resilience. I am going to work super hard to build this new business and make it bigger and make it better.
Yeah. And there's something a little contrarian in there that, if others aren't there, you get better deals, better terms, and that can support the return. Yeah.
Absolutely. That's right.
Nice. Well, tell us a little bit about sort of the first fund and how it's going with your initial managers. And I think you touched on it up front, but just in case people missed it, talk a little bit, repeat maybe the model about how you bring managers in and how that structure works.
Sure. So we raise funds with essentially a 4-year fund they're closed-end funds. And closed-end funds just means that our limited partners cannot redeem. But our fund has a certain life, and when it gets through its life, it winds down and the capital returns to the LPs. So we bring on managers, and I'm going to give you the default setting. There are various exceptions on either end, but we don't have to get into those details. Manager joins for 3 years from the day they launch with Expect Equity. So the day they place their first trade with Expect Equity, they get 3 years to invest and build a track record. They get 3 years to develop those institutional LP relationships. And then at the end of 3 years, they kind of proverbially get kicked out of the nest. And by that time, they should have established their own management company and raised capital. And again, we try to help them with that through this relationship development process. And they become an independent firm. And then our firm gets a 10% revenue share in their business on all fee and carry revenue they get. Carry is not technically considered revenue, but for the purposes of this discussion, 10% of all of it for 10 years. And our founding investors own a piece of that. So that's kind of how the model works. We raise funds sequentially, so more like private equity. Our fund 1 is up and going. We're working on our fund 2 right now. Our fund 1 has 2 managers, a 2-person team, 2 women based in Pittsburgh, Ann Wicklund and Jessica Beamer, and then we have a gentleman based in Washington D.C., Corwin Shropshire. And so each manager has trading authority over an SPV, a special purpose vehicle. It's just a legal entity that keeps the track records separate. So we're developing independent track records for each manager. So that's how the structure works. So
it's almost like an incubator in a way.
It's an incubation.
Yeah.
We call it that.
Okay. Nice. And tell us a little bit about Fund One. How much have you raised, or whatever you can share about, who's jumping in and that kind of thing.
Yeah. So we raised about $100 million. We endeavor to split capital in any fund equally amongst the managers in the fund. So we're not doing any kind of high level portfolio management. We want everybody to have the same amount to run. And we're really excited to have this up and going and to have had a second manager join. I think it's been great to prove the concept, and it has enabled us to prepare to launch our Fund 2, which is structured exactly the same. It will likely have 2 managers. And this sizing, I think also for approximately every $50 million we raise, we're able to support a manager. Yeah. So that's like kind of an overview of how things work.
Yeah.
We haven't gotten to that 3-year mark yet. So we don't have, one big milestone for us in the future is going to be when the first manager kind of leaves and
goes out. Yeah.
Launches independently. And we're just, it hasn't been enough time. We're not there yet.
Sure.
But we're excited. We're excited.
That is exciting. And tell us a little bit about the process of how you connected with and found those initial managers, and like kind of what made them stood out. What's your sort of process there?
So, it's interesting. It's very hard, I think, to kind of have a systematic way to source. So a lot of it is really just networking, pounding the pavement, physically and virtually, meeting people. The 2 biggest referral sources, or most common referral sources we have, are LPs, people in the LP community, now know what we're doing. They'll send us people they meet who might have expressed some interest in launching.
Yeah.
And also, other investment firms, often ones owned and run by underrepresented managers, but other, professional investors, other GPs, have also been a great source of introductions to managers. For our existing managers, Ann and Jessica, when I met them, they had been working together at the same firm for 17 years. That is highly unusual. It's highly unusual to have that duration and tenure of a relationship working together. Yeah. And as a result of having been together at the same firm for so long, they had what I believe to be a very time-tested investment process. The other thing that stood out to me about Ann and Jessica was they had put a lot of effort into researching how to launch. This wasn't a new idea when I was introduced to them. And because they had done so much research and because they had seen what was out there, they understood why our model plugged a lot of the holes. So they got it. Really,
they saw the value, and
because they'd done so much homework. And so that's something that we look for. And again, it's not that if somebody doesn't have that attribute, we won't consider them, but we do love to see that people have wanted to do this for a long time. It's not a new idea. It's not that, this thing called Expect Equity exists and now I might have a path to launch. But I have that entrepreneurial spirit and drive. I have that confidence. I believe I can do it. I believe in my investment approach. And I've sought this out and just haven't been able to find it.
Yeah.
It's something we love to see.
There.
With Corwin, he had, investing had been a long-term passion of his before he started working in the professional investment industry. So he came at it from, this is something he developed as a very young adult, a fascination with, and ultimately made his way into, being an analyst at industry in some large firms. Yeah. But the other thing, he, right after college, he went to Morehouse. Right after college, he worked at Delphi Automotive. There may be a number of people on Wall Street who have seen a factory floor as part of a sell-side bus tour. There are very few who have worked on one.
Yeah.
And he has insight into industrial companies because he spent years working at one. And that is reflected in how he thinks about his portfolio, how he thinks about investing, how he thinks about, finding businesses with durable competitive advantages. So having that operator experience is, I think, a little bit more uncommon in public equity, and particularly in kind of the industrials area. You see it a little bit more in healthcare. But those are those are just a couple examples of things with both of our PM team and Corwin as an individual that really got me interested in spending more time with them.
Yeah, that's very cool. And what about in terms of sourcing managers? You're finding that, do you work with consultants at all? Because obviously they're doing a lot of manager due diligence. Or are they pretty closed about that?
I mean, I would definitely say, we do know people in the consulting industry. I think usually by the time they meet a manager, that manager has already gone down the path of forming their management.
Right, they're further along.
They're further. We need people who want to do it. And look, it's easy to get an LLC. If you've gone out and gotten one and you just decide you're not going to use it, that's okay. But if you have built service provider infrastructure, if you have started trying to hire people, if you have, if you're that far along, if you've decided to kind of go down the independent launch path, I guess theoretically there's a scenario where, you try that doesn't work and you realize that, the kind of support and infrastructure that we offer would be helpful. We would consider somebody in that circumstance. But if you've decided to kind of go launch independently, then we don't have a way to work with you.
Gotcha. That makes sense. And so what does success look like for you and the managers? I mean, obviously you said like kind of leaving the nest and being successful and performing well financially. Is that sort of the key metrics that you look at for the managers?
I mean, for the managers, the first one is getting launched independently. And the second one is creating a durable business that you can grow over time. And grow doesn't mean grow to the moon. I mean, there may be a natural capacity constraint on your strategy, and that's totally fine. Running a business that lasts for many, many years, that we hope will generate a great returns for investors. But we're trying to catalyze. We're not just trying to launch businesses. We are trying to catalyze the creation of durable businesses.
Fantastic. And how about for like Expect Equity, do you have goals around how many managers you hope to bring through in coming years, or is it sort of see how it goes?
It's not kind of specific to number. Our approximate cadence of starting new firms or starting new funds, is about every 2 years. And depending on how much capital we raise, I think every fund is going to probably have 2 to 3 managers. Again, a manager can be a person or a 2-person team. So, you can do that math and get to some number, but there could be, if we're able to raise more capital over time, we'll bring in more managers. So we don't necessarily do it by kind of measuring the number of launches or even necessarily measuring the amount of capital our managers ultimately raise. But what we're really hoping to do over the long term, in addition to creating these durable businesses, is to change the conversation around and the behavior around how people think about allocating capital.
Yeah. Nice. That makes sense. This episode is made possible by Metis Global Partners, a global equity solutions provider managing over $5 billion. Metis offers both active and customized beta strategies for institutional investors. Through their guided beta product suite, Metis provides custom passive equity solutions to clients desiring sustainably aligned equity and real asset portfolios combined with a high-touch partnership. Founded in 2013 in San Diego, California, Metis serves a wide range of institutional clients, including foundations, endowments, nonprofit, university, public plan, corporate, and family office clients. To learn more, visit www.metisgp.com. That's metisgp.com, or email info@metisgp.com. The Intentional Endowments Network's 2025 annual forum will take place on October 27th and 28th at Goucher College in Baltimore. This forum will convene 100 to 150 endowment, foundation, and sustainable investing industry leaders to discuss how to maintain intentional investing momentum at your institution, covering topics including system-level investing, the fiduciary duty case for sustainable investing, strong democracies and political risk, climate risk and opportunity, responsible technology and artificial intelligence, inequality as investment risk, and taking an expansive approach to talent. The program will be designed for endowment and foundation trustees, chief investment officers, and investment teams, as well as practitioners from investment consulting, outsourced CIO, and asset management firms. IEN events are intentionally designed to be highly interactive with plenty of time dedicated to dialogue at roundtables and networking, in addition to excellent presentations from experts and peer institutions. Go to intentionalendowments.org and click on Annual Forum to learn more. Obviously, in the past 6 months especially, we've seen this kind of dramatic shift in the political climate and these sort of attacks on DEI initiatives and the like. Has our conversation sort of impacted your model at all? And if so, how?
So I get asked questions about this a lot.
Mm-hmm.
I would say it has impacted what we do, not at all.
Mm-hmm.
One of the things that we've learned over time, and I think gotten a lot savvier about, which is, unrelated, frankly, to the change in environment, is to be better able to triage LPs. So to figure out what types of LPs our work will resonate with and spend our time with those LPs. So, while there are many, many kind of macro problems with the environment writ large, it's been clarifying for us. Maya Angelou famously said, when somebody shows you who they are, believe them, right?
Mm-hmm.
So before, people didn't always show you who they are. Now they do.
It's just clear who to work with. Yeah.
It's a lot clearer to us who
Yeah.
you should spend time with. And as a small team, I mean, we're still in many ways a startup. Most people, I think, would still consider us a startup. Time is a very precious resource for us. And so spending it with people who want to kind of talk but don't want to act, it's useful.
Yeah.
Helpful for them. It's not helpful for us. So I think it's been clarifying.
Yeah. Nice. And I mean, I've heard you use the language in talking about those types of allocators that kind of get it and want to move in this direction as taking an expansive approach to talent and kind of moving away from any of that DI language or whatever, which I think is just a great phrase because I think it encapsulates so well the work you're doing. And just like you said, kind of your tagline that, excellence is evenly distributed, but talent is not. And so, yeah, I guess kind of share more about what you mean by that. And, I guess maybe also just like why you think for those that don't sort of get this or see the light, like why that might be.
Yeah. So sorry, just one quick item. Excellence is broadly distributed, but capital is not. Talent is broadly distributed, but capital is not. The people with whom our work resonates fall into a couple buckets.
Mm-hmm.
One is people who tend to be, because of their investment culture, because of the incentives at their firm, because of the types of clients they attract, whatever it may be, are very, very focused on finding great talent and returns. And they believe that you have to turn over more stones to do that. That the kind of the systems of capital formation that exist today funnel certain types of people into everybody's universe. And some groups believe that, only maybe a very small handful of those are truly going to generate excellent returns, but they need more, right? They need more. And so we are an extension of their sourcing. We are kind of R&D for them. We can unturn stones they can't turn over, right? Because they don't have they don't have the infrastructure to get the track record. That's not what they do. It's a different business, right?
Right.
So there are people who are very focused on finding talent off the beaten path, and we amplify their ability to do that. There is another segment of the allocator population that is sophisticated about connecting the fact that if they think about their organizational mission that all of their grant dollars ostensibly support, that it is as important to have their investment portfolio have alignment. How you do that, there are lots of different ways to do that. But they realize that if the left hand and the right hand never talk, there can be things going on over in the investment portfolio that are exacerbating the problems that they're trying to solve in the grant portfolio.
Mm-hmm.
So if you step back and you say, does the existence of our organization improve or create deterioration in the issues we say we're trying to solve? Are we making it better on net? Or are we making it worse?
Right.
What still the vast majority of philanthropic institutions, at least in my observation, do is they say the investment, like there are people who do investments and they do investments and we want to maximize, risk-adjusted returns. And then this other team, we're going to deal with our values alignment issues, our mission, and our grant dollars.
Mm-hmm.
And so they don't say, we're paying millions of dollars, like both sides, and if it's a large organization, are paying out millions of dollars. Right? I mean, they've got all these metrics over here on like this millions. And on the investment portfolio side, the only metric that goes with those millions is the net returns. You don't look at how the millions of fees trickle back into society and politics and influence networks. People who realize that connection care who manages their money. They might care about a bunch of other things too, but that's one of the things they care about. So those types of groups tend to be interested in what we're doing.
Mm-hmm.
And then the third, I would say, when you have like the for-profit allocators, consultants, OCIO firms, they're trying to appeal to a wide variety of clients, and some are, some aren't. And some clients are like the philanthropic organizations I just described, and they care about this. Then the firm will shut themselves out of attracting that business if they can't show how they're incorporating that thinking into their portfolio construction.
Right. On the OCIOs, do you find, and maybe it's a mix, do you find those that are leaning into this are doing it because of that client demand you just talked about, or because of the potential for outperformance, or both, or some combination?
It's very case by case.
Yeah.
I've seen it where it's both. I've seen it where, we love to see it when it's both, right?
Yeah.
They want to win more business, and they think, and the way you can tell, it's really easy to tell. The way you can tell is when you read an RFP, right? Does it say, if they're often, maybe less so now, but often RFPs have questions about, manager underrepresentation or the demographics of your general partners or asset managers.
Right.
Do you say, yes, we offer, portfolios that can be constructed with, we have underrepresented managers. Some people call them emerging managers. I don't want to get into that as another term, but, and we can build that for you. Or, which is basically saying they get a seat at the kids' table. They get a seat, but it's at the kids' table.
Right.
Or do they say, we find great managers of all stripes, and we populate our core portfolio with those managers because we believe in them. That's how you know whether somebody is doing it just for clients or whether they're doing it for talent.
Right. And they really see it. Yeah. Nice. And what about those that, you said you tend to just look for those that kind of get this and are looking for these opportunities. But what advice do you have for institutional investors that, maybe want to explore more exposure to underrepresented managers, with the idea that can give them that competitive advantage, but maybe just don't know where to start or feel, constrained?
So when you say institutional investor, it matters immensely, I think, who at the institutional investment organization you're talking about.
What role?
So so there's three, I think there are three broad categories. If you're a trustee, look at the portfolio I have, and I'm going to look at my incentives. What incentives have I set for the CIO, and what incentives has the CIO set for the team? And you will, I think, undoubtedly see very good alignment across those. What you're incenting is what you're getting. If you are a CIO, if you're a leader, you need buy-in from your board if you're going to change those incentives, or you yourself will face career risk.
Right.
Like people, it's natural, and I don't judge it, right? People are trying to further their careers. Everybody's doing that.
Yeah.
And we can't expect people to not do that, right? I mean, it's just, that's not human nature, right? I mean, that's like, that's not what Adam Smith said, So you have to harness self-interest, I think, to change decision-making frameworks and structures, to change goals and create the outcomes that you're looking for. So I think this whole kind of the science of decision-making and incentives is really important in thinking about how to solve this problem. So, if you're a trustee, it's about what incentives do you set. If you're a leader and you believe that your incentive structure is misset to achieve what you think the organization's mission and goals are, it's about going to the trustees and trying to get a change, or engaging with your chair on, I've seen trustee rooms evolve. When different people are in the room, different decisions get made. And if you work at one of these places, if you were a head of public equity or an analyst or associate on one of those teams, or it doesn't matter the asset class, sure, you're responding to those incentives. You can raise these issues, but if the organization never responds to your interest and you believe that a ton of talent is getting overlooked, I think in most cases, that person is not going to stay at that organization forever if they have other choices.
Yeah.
So I think what you're going to see is, we already see this, right? People sort according to, finding jobs and careers that align with their values. So.
And those people can speak up too, right? I mean, the same way the CIO can raise it with the trustees. They can say, I think there's an opportunity we're missing for competitive advantage here, and have those conversations. But I think that's laid out really nicely because, everything we do, we see the same sort of thing, whether it's, manager representation or climate change or sustainable investing or impact investing. It's like the policy needs to be set at that trustee investment committee level for the investment team to have anything to really do. And, but at the same time, it is a tricky dynamic because the investment teams are the ones that are on the ground that might see the opportunities, are doing this day in and day out. And then you've got these volunteer trustees. I mean, many of them are investment professionals too, but, they might not always think of these things because it's not their day job. So I think that those conversations need to go both ways.
I mean, the other thing that we have thought about and haven't figured out how to solve, and frankly just don't have the bandwidth to address right now, but hopefully someday we will, is I do think there is some propensity for trustees with finance background to occasionally, again, not a universal statement, but occasionally either intimidate, or maybe it's the fact that other people are intimidated by them. And thus you have people who might feel that because they don't have the background in finance, that finance is very complicated and you have to have been in this field for a long time to understand it. And I do think there's this dynamic where people might see these things that I'm talking about, but feel like, oh, well, they know what they're doing. They've worked on Wall Street. They worked at Goldman Sachs or Morgan Stanley, whatever. Like, I can't ask that. And that must be a dumb question. I'm sure somebody's considered that.
I would say absolutely. Yeah. You're talking about like fellow board members, trustees that are
fellow board members, right?
100%.
And I know this because I have talked to some of these trustees who don't have the finance background, and we talk about all the things that you and I have been talking about, and they immediately get it. These people are very, very accomplished, just in a different field. If they had chosen to be in finance, they would be accomplished in finance. They completely get it.
Yeah.
But those people need it. They need support also, right? And they need to believe that they're not going to be ridiculed, and they need to believe that they're not that those ideas are going to be taken seriously. And those are hard questions you're putting people in tough positions. So maybe someday down the road we'll be able to create some kind of support structures, just education to say, you know what, there's some of finance is really complicated, but you don't need the most complicated pieces of it to address these issues. These issues are relatively simple.
Yeah. And yet, like there's a tendency just because of the culture and the jargon to kind of make it seem more complicated than it really is or needs to be at that governance level. Yeah. No, and I mean, that's really what we see a lot of the work in our network. And, the purpose of this podcast and all the education we do is to help people, kind of elevate those conversations. And so, and, we talked a little bit about it earlier, but it'd be interesting to explore like what kind of guidance or support or tools we could give to boards and investment committees to set those incentive structures appropriately, or to at least like recognize, even if they're inadvertent incentives that they're setting that they don't realize they're setting, to kind of continue with the status quo and go with the well-known funds that everyone's already piling into. Could be really interesting. Yeah. Well, this is great. Going to do our few final questions here. First with some quick takes. So, you're in the midst of an entrepreneurial endeavor yourself, getting this exciting new model off the ground. What's been the sort of most exciting part so far in this journey?
So I really, really struggle with this question because it's almost impossible to point to one single moment. But I'll say I think there is a single kind of revelation or takeaway, which is that you're often making progress in small daily ways that you can't see. So imagine you're kind of pushing a rock up a hill, and when you get to the top of the mountain, the rock is going to go over the top and it's going to roll down the hill, right? So every day you're kind of pushing it higher, but you're pushing it up, and all you can kind of see is that I'm pushing it up.
Yeah, the back.
You can not see. Yeah. That's right. That's all you can see. Your perspective is limited to the back of the rock, and then you can't see, the mountain range, right?
That, or how far up you've gotten.
Exactly. And you're getting closer to the top, right? And so I remind myself, when I tend to get frustrated, I remind myself the rock is moving up the hill, maybe not as fast as you want, and but you are, and so when you think about, again, I care about kind of decision science and motivation and things like that. That helps me keep going even when something's frustrating.
Yeah. Nice. Nice. And what about, you just talked about careers in finance. What if you hadn't pursued a career in finance? What do you think you would have ended up doing?
So I think this won't be surprising after this discussion. I think I would have been a professor of organizational behavior. So, all of this, like how, why do people make the decisions that they make? Why do some organizations succeed and some fail? So I'm fascinated by that. I read a lot of social psychology and organizational behavior related work.
Mm-hmm.
So
Yeah, that's great. I think about that. We sort of work in investments, but it really is organizational culture, like mindset, how these board dynamics work, like we were just talking about. That's really what's at so much of this, at the core of it. I said, how about a book or a podcast, article, some sort of resource you'd recommend for people that are interested in learning more in this stuff?
So a few months ago, this book, The Doors You Can Open by Rosalind Chow of Carnegie Mellon came out.
Mm-hmm.
And it is a book about sponsorship. And she distinguishes very clearly sponsorship from mentorship. And she talks about the power of sponsorship in changing status, opportunities, influence, and decision making. And I think it's a very powerful message. And I think it's very applicable to the investment world. For, again, all reflecting back on this conversation, for all the reasons we've discussed, there are a lot of people, there are a lot of managers in the investment world who are the beneficiaries and recipients of immense amounts of sponsorship. Mm-hmm. Often don't even know it, but just expect it, right? Mm-hmm. That's sponsorship. So calling another allocator and saying, my firm is investing with manager X, we're trying to help them raise money, how about if you would consider investing also, is very powerful. And it's far more powerful than calling another allocator and saying, meet my friend, manager X, but we're not investing, right? So sponsorship is a key currency of decision-making in the investment world. But some people are far more prone to be recipients of sponsorship than others. Mm-hmm. If you look at why this intransigent problem of capital allocation, why it continues to be so intractable, this is one of the key reasons why. And I think Rosalind does a fantastic job of explaining this.
Yeah, fascinating. The Doors You Can Open is the book.
Doors You Can Open.
Nice. Excellent. All right. Well, Hallie, what is your vision for the future of finance, given what the work you've done?
So I referenced it earlier in that it's a world where there's institutional consistency across all of an organization's assets. So when people don't just look at the grant side, or they don't just look at the endowment's contribution to the operating budget, but they look at what they're telling their students. They look at the more just world they're trying to create, the more, environmental, reduction in climate change they're trying to create, whatever it is, right? Yeah. Whatever your goals are, your investment portfolio, in terms of it may have something to do with the securities you own. Again, it would be up to any organization to define this. Right. But one thing that should not be ignored in that process is the behavior of the people who you pay to manage the money. It is a privilege to be entrusted as a fiduciary to manage the assets of any endowed institution. I think a lot of GPs get confused. They think it's a right. It's not a right. It's a privilege, right? And I think that honoring that privilege truly involves not behaving out in the world in a way that's counter to the mission of the people who have entrusted you with their capital. Yeah. But I think right now, very few people think about it that way.
Yeah. Well said. Nice. And then finally, and this one's particularly relevant too, what kind of advice would you give to young people or college students that are interested in getting into the investment space?
Read Angela Duckworth's book, Grit. It's passion and perseverance. And it tends to be in her, observation that people really excel at things when they are passionate about it and persevere at it. You tend to persevere at things that you are passionate about. If you don't like reading 10Ks, if you aren't interested in studying businesses, if the Warren Buffett way sounds boring, you're not going to be a public equity. Like, you can go be a public equity investor. You might be able to prep and get a job, but you're not going to love it, and you're probably not going to be very good at it, right? If it's not exciting to you to read about new technology, to read about how AI is changing software. Talk to founders or to identify, or if it's, the care economy or something about consumers. There's lots of different verticals. But if talking to founders, trying to innovate and solve problems isn't interesting to you, you probably shouldn't be a venture capitalist. So think about what you love doing. And then if that aligns with anything in the investment world, that should guide you to where you're most likely to be successful, because you're most likely to be successful in something that you love doing.
Mm-hmm. Perfect. Well, Hallie, thank you again so much. This has been such a great conversation. And I just, I'm so impressed and excited by the model that you all are rolling out there. And thanks for taking the time. I hope to catch up again soon.
Thank you for having me, George.
This episode has been brought to you by Metis Global Partners and by the Intentional Endowment Network's 2025 Annual Forum, taking place October 27th and 28th at Goucher College in Baltimore.
Thanks for tuning in for the Future of Finance podcast. We hope you found today's conversation insightful and inspiring. Don't forget to subscribe or follow us on your favorite podcast platform. And please take a moment to rate, review, or share the show. All of this really helps us to reach more people like you who care about creating a thriving and sustainable future. And it's a really easy way to have a big impact. So please do follow. A quick disclaimer, the content of this podcast is for informational purposes only and does not constitute investment advice. Investments and strategies discussed may not be suitable for all listeners. Please consult a financial, legal, tax, or accounting professional before making any investment decisions. References to managers and funds are for informational purposes only and should not be considered endorsements or investment solicitations. This podcast does not monitor fund performance or guarantee the accuracy of third-party materials or statements. This has been an episode of the Future of Finance podcast, exploring how finance can shape a vibrant and sustainable future. Thanks for listening, and we'll see you next time.